Okay, so shall we start? We've muted all your microphones, therefore please send any questions via the Q&A, which I may answer as we go through, or I'll defer as is appropriate. Really, just to position this, this webinar, this follows on from the previous masterclass. In the previous masterclass, we talked quite a lot about the business benefits of cash flow and why as a business you do it, and how your interaction with your clients, and how to open up different market segments in terms of cash flow planning. So today is kind of the next piece, which is how do we then do this? Realistically, how do we do this? So now let's look at the agenda today. And you can see there the introduction. I guess I ought to introduce myself. My name's John Bethell. I'm a business consultant at IRESS, but I specialise in cash flow planning. My history is 30 years in the financial planning industry, and latterly, when I was on the industry side, so to speak, I ran the cash flow proposition for a national wealth manager. So my background is very much financial planning and living with clients and clients' needs. In a moment, we look at the learning outcomes, but my overall aim today really is to show you that cash flow planning is straightforward. It can be quick and easy at the right level. I think in the marketplace, there's an acceptance or an understanding that cash flow is complex and it takes a long time and it's costly, and it needn't be. At the same time, also, then move that from a very straightforward scenario, very straightforward piece of cash flow planning, through to something more complicated that really starts to show the benefits of the financial planning unwinding. Inevitably, we all live with compliance. And I genuinely believe that cash flow planning can help us support the information for to remain compliant, and I'll touch on that as well today. And then sort of taking a lot of that theory and a lot of that kind of scenario building and what you can do with a cash flow tool, I'll then give you a very quick run through on how I personally would run a meeting with a client, actually using the cash flow output live, and what sort of screens I'd use and how I'd use it. I think within the IRESS sort of family, the main cash flow tool is very much the granddaddy of the calculators. That said, we have a number of other small lightweight calculators that can enable you to open up your clients. And so I'm going to look at the retirement funding tool today, which is a really great little tool that I could use on an iPad in front of my client just to say how much is enough in terms of pension. So really quite limited, quite small, but fast and easy to use, very client friendly. So now let's move on and look at the learning outcomes. So that really summarises what I've said, and just trying to break down that perception of cash flow takes too long and is difficult. So really, let's get on and get into the tool. And as we do that, there are parts that I'll pick out. So I think the first point I'll bring out is the benefits of the cash flow tool being embedded within the X-Plan system. When we think about the client journey, we'd go through, for instance, the fact find. And you'd go through and you'd input into X-Plan all the details from your fact find. Once it's in the system, we then look at IRESS to really manipulate that information as much as possible and get best value out of it to save you rekeying. So the immediate benefit is you've keyed it in one place and we can then use it again. But what I'm going to do now is I'm going to actually run a live cash flow for you, start to finish, so that you can get a feel for how long this could take, how long this can take. So I'm just going to label that current position. And I'm going to pick up a template. So within the background, within Cashflow, we can have a number of templates that will just overlay your house settings. Okay, while we're going in at the moment, I've just had a question that says, are we able to offer the Cashflow tool to AO clients? And at the moment, there isn't a plan to integrate this into AO, though I know that we do have a couple of clients that use this standalone. It may be something that will come onto the roadmap later on, but it's not on the roadmap right now. So anyway, we're building our scenario. We've picked up our templates, and you could, within a business, you could have a number of different templates for different client scenarios, maybe for a pre-retirement template, a post-retirement template if you want different things. And you can see it brings us in to the Cashflow tool. So the next thing I'll need to do is to bring the information from Xplan into the Cashflow tool, but I do that via the import wizard. And I could just press import all, and that's quite quick and easy. It'll just upload the information. I'm just going to click proceed today so that you can see what sort of comes through. So this isn't a lightweight integration, this is a full integration. And I can control what comes in. So if I just want to bring in the pension information, I can. I'm going to bring everything in and just let that import wizard work away. And we get that lovely reassuring note there that says the import's complete, and I can press OK. So that has now populated my tool. And I'm just going to make some basic changes and additions as I go through. So for instance, I'm going to change that retirement date to 2030. So the clients are retiring at age 60. In the main system, we've got them retiring at state retirement age. There we go. And then we've got some dependents and beneficiaries there. So we've got some children who've come through. So all this detail has come through. I haven't loaded it in the cash flow. It's just been drawn through automatically. Incomes have come through in the normal way, as have the expenses. So I'm now going to move on, just look at the assets for a moment. And I need to be thinking about what growth rates I'm going to use here. So I'm going to go to the rates and fees, and I'm going to say for my current account, I'm going to have a cash interest rate, and similarly for my emergency reserve and my deposit account. And we can see here that the system is using a conservative growth rate. So these are portfolio growth rates, any number of them there. But actually, I want to use a defensive portfolio for this client. So I'm going to go to a central place in the settings screen, and I'm just going to update that from conservative to defensive. And that's now populated the defensive rates of return. There's some ISAs brought through, there's some property brought through, but I'm just going to jump now to the pensions area. And you can see here it's pulled through the two pensions they have. If they had 10, it pull it all through. And it's again populated the growth rates for you. The contributions are all there based on what's loaded in Xplan. And one of the comments I would say is that the key here is the better the quality of your information in your main system, the better the quality of the outputs within Cashflow. Okay, so I'm now going to set up the at retirement. So because these clients aren't retired, there's no at retirement in the main system. And so I'm just going to add some very basic drawdown, bearing in mind that this is a current position. It's very lightweight, deliberately in terms of cash flow planning. And so I'm going to put down and let me talk a little bit more about the current position. So I see a current position of showing the client where they are now. So if they don't take any further financial planning advice, or they haven't taken any to date, this is where they're likely to end up. It's the old story. Show them the problem, then show them the solution. Which is why this particular scenario is quite lightweight. And all I'm saying here is, okay, at retirement, take your benefits, tax-free cash, draw your income. I know with pension freedoms, that's not something we'd necessarily look at immediately. We'd look in terms of using those flexibilities and drawing some tax-free cash, or drawing some drawing tranches and whatever else, and this tool will do that. But at this stage, I want to show the client the problem. And so what I want to know is, if they just took their pensions in, I think, the normal perception of cash flow, then this is what they would get. This is where we'd end up. And I've just pressed that little grey button there, and what that does is it optimises the income taken. So we've taken their tax-free cash, and the tool will then work out for you how much income they can take on a regular basis, either indexed or not, your choice, to take that fund to zero at the end. So if you're thinking about your drawdown reviews, and so that little touching on compliance area there, drawdown, what's the sustainable level of income? That's it, given that growth rate. So it's a very quick and easy way of you jumping through that review, drawdown review situation. I just label it drawdown review 2019, job done. And that will have taken me all of sort of 5 or 10 minutes. 5 minutes. So we set up our pensions. One of the areas I'm going to touch on as well, I'm not going to talk about defined benefits today, but it's full defined benefits in terms of calculations for any defined benefit transfers. I'm just going to touch on a couple of areas. We will be looking at death and disability today. So I'm going to go into the key information here for inheritance tax. And what this does is it says what happens on death to these assets. So the custom means I can go into lots and lots of detail. Okay, so I can just specify each deposit account, etc., each investment, each savings, each property, etc., into exactly where it's going on death. So that works for IHT and death. But today I'm going to be, frankly, in the current position, just a little more lightweight. I'm just going to say, right, on first death, it's all going to go to spouse. And on second death, I wanted to go to the children. And to get the property nil rate ban relief, I'm just going to put in a dependent split here. I'm going to label it as children. And I'm going to say they're the two children, 50, 50. So what that means is on first death, everything goes to the spouse. On second death, it's now going to go to the children. So really quick and easy to do again. In terms of distribution, I am just going to pick up just some bits and pieces on pensions, and just make sure that on death, they're transferred as pensions rather than transferring as cash. I'm then going to go to the what if area. So what if they were to die? And again, I just want to pull out some thoughts around this for you. This can all be templated. So what this area of the tool does is to say what happens on death. At a high level, on Fred's death, his income stops. Helen's income continues and the joint income reduces to 50%. In terms of expenses, on Fred's death, Fred's expenses stop. Helen's expenses continue at 100% and the joint expenses continue at 100%. These, you decide as a business and you template. So you don't have to use our assumptions, their assumptions, and it just comes up like that. And what that enables you to do is to have a really fast pass through, have they got a problem on death? If one was to die, is there an issue? Yes or no? If there is an issue and the client agrees to pay, you can then go into by source, and that means you can pick up each income and say exactly what happens to each income, what happens to each expenditure. So you can get really, really detailed should you need to do it. But on this pass, it's just a quick current position, where are you, where's it going? Similarly with illness, exactly the same principle. And I'm just going to assume that Fred is off sick for 5 years. And again, I've got the same sort of templating here, that the expenses here are slightly different. Fred's income stops if he's ill, Helen's continues, any joint carries on by 50%. And similarly with expenses, Fred's expenses have dropped to 75% of their original, but 100% carries on there. Let's move on then and look at the cash flow allocation. And within the cash flow allocation, what this really is, to me, the financial planning benefit of this tool. There's a load of compliance benefits to this tool and a load of projection benefits. But for me, this is the strength of the tool. It's saying, if the client has spare money each year, what do they do with it? Now, my experience tells me they do one or two things if they haven't had advice. They either spend it or they save it and say on deposit. And I'm just going to say for the current position that they're just going to save it. And then if they don't have enough money, they're then going to draw down on their assets each year in this sort of order. And these are all, you can specify all these and you can template this again. So this needn't be, these aren't IRESS assumptions. This is what you want from the tool. And you can change them for individual clients. So let's then move on and just have a look at a chart and what that means for our client. And because of the nature of the time limits of today, keeping things fairly tight, I'm not going to go into into too much detail, but we can see in terms of the charts, there's a lot of them, some quite detailed ones, some quite simple ones. But we can see at a glance, do you know what, the client's running out of money in their late 80s. So that's fine, that's what it is. If they carry on doing what they're doing, then according to this tool, they can't achieve their objectives. Let's just have it move on then, so we know that's an issue. Let's now move on and just have a look what the position is on death. So if Fred was to die, and I can change the dates that Fred dies, we can see this kind of chart we've kind of seen just previously, but if we bring in what happens on death, we can see they're running out of money much earlier. And I won't go through, it's up to you in terms of your disturbance tools. I'm sure you can use that as you wish. Now, that's fine. I've very quickly got to the point that actually they've got a problem, so I can raise that with my client. Is that something they want me to deal with? But I can also get an idea of broadly how much life cover might they need. And I think this at the moment is in broad terms because we've made some assumptions in terms of their of what they're doing with their incomes and their expenditures, and assuming all the assets go to the surviving spouse, etc., which may not be the case. But you can see here it's about 1.2 million they need as a lump sum now to be able to erode that. So that gives you an idea of, to be able to say to them, you know, it would be quite a lot of life cover at this stage, or it would be a reasonable amount. Maybe we need to talk about this in more detail, get the more detail. Once you've got the detail, you can then go back into the input screens as we were before, and we can then go to the by source, make the tweaks we need. Similarly, in the inheritance area, make the tweaks we need, and away we go. We can then produce a second chart that shows them in a better position. Even loading in the life cover. And what a powerful way to really look at your suitability report for the life cover, to say, here's your current position, this is the problem we're trying to solve, here's the life cover, here's the second graph having implemented the solution that shows you're in a much better place. Exactly the same sort of principle on illness. And I can see here that the client's going to run out for if they're ill for 5 years, they're going to run out of money around age 68, 60, 69. So in their mid-late 60s. And I'm always quite vague about the times because this is just a projection after all. And I can then go into the target and regular and illness. And that will say how much do they need to reduce their expenditure by to break even at the end. Or I could be cleverer than that and just say, actually, in terms of PHI, what might I be able to do? I might be able to say, well, actually, the term for the regular amount is broadly 5 years. And it will give me an indication, bearing in mind this client's on a salary of about 100,000. Am I in Helen? Sorry, I'm in Helen. Sorry, I do apologise, I'm in Helen. We'll just let that work away. So, you know, we know we'd have to maximise their IHT, their income protection to make that work. So we'll go back then into the capital wealth chart, and that is a very basic summary, and that's taken me, what, 15, 17 minutes with discussion around it as well, 15 minutes to build a basic cash flow. I now want to get cleverer. So what I'm going to do, I'm just going to duplicate the tab. And I'm now going to save this out, just copy the scenario to date, just label it as planning. And I'm now going to go back and I'm going to have a quick think about some of the things I might want to do from a financial planning point of view. And these are by no means all, this is just for illustrative purposes, but I might, for instance, think, well, actually, do you know what? They've got some ISAs there. What I'd like to do is I'd like to auto ISA because they've got the GIA. I'm just going to take the GIA value, and every year I'm going to use the client's ISA allowances. Fantastic. I'm now going to look at the pensions and say, well, I want to be a little cleverer in terms of the way we draw down income. So actually what I'm going to say is I'm going to ask the tool only to take income from the pension when they need it. And the way I do that is to go into the cash flow allocation. And this, I think, is where we're going to see some of the real benefits of the financial planning. And I'm now going to say, well, actually, I'm going to repay debt first, as per the FCA hierarchy of need. I'm then going to fund my pensions. I'm then going to fund any ISA. If I've run out of money in the GIA, I'm going to fund ISAs. I'm then going to go into add to the GIA. Similarly, in retirement, if there's any debt left, absolutely, I'm going to get that repaid. I'm not going to fund pensions in retirement. I understand there may be financial planning reasons to do so, but we're not going to in this instance. We're just going to fund our ISAs. We're then going to fund the investment-based assets. And then I've switched off, remember, the pension income. And I'm going to ask the tool then to wipe through any cash assets. If I wanted to, I could protect an emergency reserve, absolutely. I'm then going to ask them to go through their ISAs, then through their investment base, then their bonds, and then I'm going to ask them to go through their drawdown funds. So what difference does that make? We're just about there, aren't we? We are there or thereabouts. So what we're saying is actually we've made a significant difference to this client's situation. Let's now have a look and see what we've actually done. So I'll go back to the original scenario. I can see the gross wealth. And what this does is it breaks down all the asset types. So we can see our liabilities there being repaid over time. We can see our pension funds, then tax-free cash, and that's our drawdown fund. And we used that maximise button, didn't we? Which said that it would take the pension right to the end of the day. If I now compare that to the gross wealth chart, I can see here that actually the debt's been repaid earlier, the pension funds leap once that's been paid, because that's where we said the extra money could go to. That's taken it to our drawdown funds, and our drawdown funds continue to rise, which then takes it out to their funds lasting much longer. So we've done two things here. We've made their funds last much longer, but we've also meant that if they were to die off early, we've left their liquid assets in an IHT efficient environment. Now, clearly, in a financial planning term, you would spend a little more time, but to deliver a slightly more elegant solution of using personal allowances and whatever else, and you can do that. But again, in a very short time, I've taken you through a current position and a planning scenario, and I hope that starts to debunk the myth that cash flow takes time and is expensive. It needn't be. You just need to be focused on what you're delivering for your client. In terms of compliance, I think there's a number of areas there that we can look at. But what I'm actually going to do now is to take you through into how I would present this. And so just very simply, I'm going to take you through just into one of these scenarios, and I can then present this to the client. So the Engage tool is just a pretty front end, if you like. It's just an easier version to work with. All the information's in Cashflow, it just replicates it. So where I would start would be in the display screens, and I would run through the balance sheets. So this is the cash assets, all their assets listed out, along with their liabilities. We can include various or exclude various bits and pieces. I would go through their statement of income. So we can say that's your income, where it is today, etc. I can also do that this year or any year. And the final one I'd probably go through, if I didn't have to, I wouldn't necessarily go into tax. For some people that'd be important. I'll go through their expenses. And again, I can see their expenses there this year or any year. Having done that, I can then go back to my capital wealth chart, which is the chart we've seen before. And I can now start thinking about showing the client what happens in terms of their risk profile. Is it appropriate for them? We know when we look at risk profiling, the FCA say that we need to look at the client's natural tolerance to loss, and I think these days most people use some sort of questionnaire for that. That will maybe kind of as one built in within X-Plan, another benefit of the through process, but also people like Phonometrica, Oxford Risk, or your own profile, or however that works. We then need to look at the client's experience, absolutely, but we need to look at their need to take risk. So if we were being pedantic or there's big changes here either way, I could go into the tool and I could go into the what if area here and target return current. And this will then calculate how much extra risk they need to take to meet their objectives. And so, as we saw from the graph, they're there or thereabouts. They'd be at 0.14. But if they had a large deficit, then it may be saying, well, they need to consider going up a risk profile if it's appropriate. And you can then have that discussion. Or if they had a large surplus, and I think this is often missed, if they had surplus funds, you can actually talk to them about whether or not they de-risk and just drop down a scale. They may not, but you've had the discussion, and that's the important part. I think as an industry, we often miss that a little bit. So that's in terms of need to take risk. So let's just go back now to our standard chart. And the client may be saying to us, well, actually, certainly if they're on that, right on that margin of risk, well, actually, yeah, I'm quite happy to go up a level of risk. Okay, that's fine, but what does that mean? In terms of market setbacks. So let's just increase our investment growth by maybe by a risk band, say, sorry, we'll go up rather than down, by 1%. So that gives us a nice large surplus. That's great. But what happens if there's then a market setback? And so we might be saying to our clients, actually, but if we go up a risk level, then we need to think about what happens if there's a market setback. So for this risk profile now, we're probably only a balanced risk profile, so we'll have a 20% crash, a setback in the market, and we can see that happening there. And that shows that the client then has capacity for loss. So if they were to move a risk band, we've now just fulfilled the FCA need in terms of capacity for loss. But that then may give us some other options. So do you know what? our clients might be saying to us, well, we're retiring at age 60, but what does that look like? This is what it looks like. We'd like to go earlier. Yeah, but with a setback, it's a bit tight at the end, but let's have a look. And so I can now start to really have those sort of client personal discussions about how that works. And so maybe we might take them both retiring. Slow that bill, they're both retiring at age 58. And sure enough, that's as expected, brought us back quite considerably with the market setback. So that's looking quite difficult. Yes, but actually what we're going to do is we're going to downsize. We're in a big house at the moment. By the time we're older, we're very happy to downsize. And so we're going to say we're going to downsize our property by 50%. And we're going to do that perhaps in 25 years' time. And so we can now start to have, and you can see that downsize coming in, we're now starting to have those really powerful discussions with our clients. What if they do this and what if they do that? And it really brings it to life. One of the cautions I'd say about this, though, is you don't need to get too carried away. Some of the graphs can get very complicated, and my experience having rolled this out to something like 200 advisors is to say, certainly in the early stages, if you're not doing interactive planning at the moment, take it gently. Start with basic graphs like these and then move to the more complicated ones later. So that's the Be Engaged tool. We've looked about how you can use that in terms of calculating and working out your client's needs. I said I would touch on the retirement tool for you, and so we'd just go there now. And the part I like about this retirement tool is it is very, very simple, or it looks very, very simple. Bear in mind that this is all touch screen. So this is iPad enhanced. And keeping this really, really simple, I've got Fred here, his date of birth, his male. I'm going to put in his salary, and we'll have it at 50,000 this time. Hasn't got any other income at the moment, and I'm going to have his retirement age at age 60. And some of my thoughts around this is actually, if I'm trying to deal with groups, stakeholder pension, I've got a number of appointments to do on in a relatively short period of time, I can be really quite straightforward. So I'm going to say I've got an existing fund of 200,000. That they're contributing, we say, 5% per annum, and maybe the employer's contributing at 3% per annum. Again, I'm going to go up a risk profile. If I haven't done a risk profiling, I could do a risk profile test here. Do they qualify for full state pension? Yes. And I'm going to vest via income drawdown. Bear in mind, this is a planning tool for future. We're not going to get that detailed at this stage. They're too far out. I think we're probably going to go for 50% of salary. And maybe 50% of salary from these funds. And we can see that at the moment, they're looking for an income time required of 35,000. They've got a shortfall. So you can have a discussion about what that means to your client. I can then go into your strategy and I can optimize the contributions. And that says, actually, Mr. Client, you need to contribute some 20,000 a year to your pension to make the grade. Well, if it's only on a 50,000 salary, that may not be achievable. You then have that discussion with the client, and the client says, actually, do you know what? I'm only prepared to contribute £5,000, but actually I thought retirement at age 60 might be a bit of a dream. I'm happy to go to age 65. And so all of a sudden, because I'm now retiring at 65, they need a revised income of 41,000 to make their ideal. But because they're only prepared to put in 5,000 a year, they're within 2,500 of their required income. So it's really, really quick and easy. I can look at retirement incomes and we can see there on the proposed that they've got a shortfall, they're running out of money in their early 90s. You can see there their assets that aren't quite enough for different journeys. I've also got a strategy summary. So this is what's happening. It's what I need to do. Here I can have a look and see all those assumptions I've put in, and I can change them again here if I needed to. So I can have a really slick and easy discussion with my client about the effect of their pension funding if I'm in a limited area. So really to conclude there, we have the main cash flow tool, but we have a number of other tools that are quick and easy to use, that are designed for you to just have single areas. So for instance, if you just want to do an inheritance tax calculation, if you just want to do some pension planning, this one I think is particularly good because of the interface that we have within Engage and the touchscreen ability. Okay, I'm just going to look at a couple of the questions. Right, a couple. Absolutely. So a couple of questions have come in. In terms of the cash flow menu, I'm just going to come out of this tool now. And just take you back. So within the standard tool, standard setup, you'll have sort of key information, advice process, and then you have X tools. And Engage is that nice front end that makes it much easier to present. And then we have the standard tool. So we have cash flow and cash flow report. Now, for those of you that have Xplan already, you may or may not be able to see these menus because they may not be enabled if you're not paying for it. The cash flow report, we have reporting comes out of each of these tools. And I think probably given timescales, I might be able to squeeze in some time just at the end of the call just to take you through a basic cash flow report. So that's where they sit. In terms of this cash flow modeler, there are ways that we can set up a kind of a shell X plan. So if you're not using, if you don't want to use the full X plan, there are people that will do where we have gotten just using cash flow alone. Though to some extent, my challenge to you would be, why are you doing that? One of the real benefits of this tool is the end-to-end process, all our information in one place. I can, if I go into the cash flow, sorry, the cash flow area here, I can lock that scenario, which means that it's help or posterity. So nothing can change, it can't be amended by anybody, and it won't take sort of new tax rate feeds, etc. So that then means if you've got an issue in 5 years' time, we can get back to the original, all stored there neatly and prettily. So I would kind of challenge, should we be looking anyway to be using full Xplan? Okay, in terms of the way forward after this webinar, if you already have Xplan, so have an existing relationship with us, then please contact your account manager if you want to have more information. I'm very happy to kind of talk to people about a more detailed sort of view of how you as an individual firm might want to tailor the tool, how it can work for you. So I think in terms of movement from AO to Xplan, yes, it can be done. That's something you need to talk to your account manager about. If you're not sort of in touch with an account manager, so you're not an existing IRESS client, then if you email sales@iress.com, then we will respond to that. There will be a copy of the webinar available. So if you just email sales@iress, then they will forward that to you. Do we have any other questions? Okay, in that case, I'm going to take the last couple of moments just to take you through the sort of output that we have within the cash flow report. We have a wizard. And so that will take us through a wizard. And for our purposes today, I'll just pick up and pull across a financial planning report of the style it produces. So that produces an updatable table of contents. That's very, very small. Let's see if I can just expand that. Okay, there, sorry. That's a better size, even I can read that now. So we've got a financial planning report there, running through it. Just a basic introduction. This is a Word document, so you can make any amendments that you want to in here. Current asset position, just a little bit of comment. The current position, so you can see here, this is their cash flow surplus and deficit. You can see here that they're in surplus before they retire, and then when they retire, they don't have enough money. And sure enough, their assets rise to retirement and then fall away, and they run out of money. A very lightweight conclusion that their risk profile, it wouldn't be sufficient to meet their objectives, what the cash flow allocation is based on. Then a second scenario, planning scenario, showing a better position with them having enough money to reach the end. And again, the surplus and deficit assumptions, because they're different. So this all pulls through automatically. Situation on death, situation on disability. Then I've put in the next steps, and the reason I put that in, and this comes through, and this bit is free text. And the point about that is that what I see is clients see pretty pictures. They don't necessarily understand they need to act. So this is just that reaffirmation that they need to act to get that final picture that they like the look of. It also means that, you know, if you do 1, 2, and 3 in year 1, you then go back in year 4 and say, year 2 and say, actually, we didn't cover off the 4th point last time, you know, your life cover. Do you want to now revisit that? So it's a call to action. And then it runs through the appendices of all the personal information, so you're not rekeying it. But that information is based on the scenario, not on X-Plan, and that's deliberate. Okay, one final question that was asked, how does the cash flow tool deal with tax and personal allowances? It is a full tax calculator. It does the lot. Personal allowances, CGT, inheritance tax, dividend rates of tax, agricultural property relief, the works. So it's a full tax calculator. Let me just slide down. Okay. Okay, we've had a couple of other questions there. Can it do stochastic modelling? Not within the main cash flow modeler at the moment. That is under discussion. One of the things that I found with IRESS when I was in a national wealth manager was they're very open to development. This tool, I've known it for about 6 years now. It has not stood still. It's a continuous development. In a number of the other tools, yes, we have a stochastic model. So I think it'd be a relatively easy move across to to Monte Carlo simulation now. The other one we've had, is it also a multi-currency beside GBP? What we can do is we can switch off the UK tax, and you can assume, then select your own tax rate. The import into cash flow will come through as pound sterling. So you may be within X plan dealing with it, dealing with multi-currency, but it depends what you report in, and I'd expect you to report in GBP pounds for this. Apart from this does work for Southern Ireland as well. In terms of how much this costs if you're an AO user, I think you'd need to talk to your account manager about that. My honest suggestion would be that you would actually consider the move to X plan because of the real extras it gives you and the real benefits it gives you, and then you lose all that rekeying and whatever else. So really do talk to your account manager about this. At IRESS, we're very used to making that move from AO to IRESS. We're very skilled at doing it to minimise the impact on your business. Let me just see. So does the system pull through, a number of questions coming in at the end here, does the system pull through Scottish tax rates? Absolutely. Yep, we have an option to move from English tax to Scottish tax, and if Wales decide to have their own tax rates as well, then that's pre-programmed in the background, ready to go. We just need to put the rates in. Does this tool create a tax wrapper analysis? I'm not quite sure how to answer that, other than to say to you, if I go back into the client menu and back into cash flow, and go into the planning. Is to say, when I go into things like the chart, the capital wealth chart, this shows you where your assets are based. And so you can see the movement of those assets with your planning. Inflow and outflow, similarly, it will show you exactly where incomes, etc., are coming from. And the other area, as we didn't really look at today, but are the spreadsheets that are in real detail, and we can actually then see exactly what's happening in terms of tax. And all these spreadsheets are exportable through a CSV. If you have any further questions, can I make a suggestion that you email into the sales@iress.com or fund them through your account manager, and they'll then come to me and I'll then pick them up from there. Okay, we've run over by a few mere moments. I do apologise for that. There is, I think, one more question come in. When there's a question about large property sales skew the graph, I would deal with that slightly differently and say, actually, what I would do is I would use the downsize, and then you don't have a buy and sell, you just have a change. And so the scales at the moment are static. That, though, is something that, again, is in development. There's a lot of development going on at the moment around using this in front of a client and how it looks, and that will unwind in the sort of third and fourth quarter this year. So I think we are where we are at the moment, but absolutely moving forward. Okay, well, thank you very much for your time. I hope you found it useful. Any questions, as I say, just to repeat, to your account manager or to sales@iress.com. Thank you very much for your time.